All right, so today I wanted to do another stock comparison video. We have Deere and Caterpillar, two pretty direct, not completely direct, but in a very similar industry. So again, as we get right into it here, analysts about the same. Dividends, Deere is growing a little bit faster, but they do have a lower dividend, right? So the 5-year growth rate for Caterpillar, 9%. Deere 15.8, right? So Deere's growing quite a bit quicker, although Caterpillar's is higher by a decent amount. The payout ratio is quite a bit higher on Caterpillar. As far as financial health goes, Caterpillar's in a little bit better shape. Current ratio, it's quite a bit better. They are buying back shares at a comparable rate. Debt to EBITDA, they're a little bit better as well. Growth, they're both actually growing very nicely. Deere is actually even nicer. Profitability, again, Caterpillar's a little bit better, although Deere's okay. Management, it looks like Deere is doing a better job there. 5-year stock growth, Deere has outperformed by a lot more, right? 189% versus 81%. So both have outperformed the market by a fairly easily margin, right? So that's the thing to point out here. But Deere has done quite a bit better there. As far as the valuation goes, right? This is where I think that things kind of differ. If you look at the PE, right? Deere, it is way below its 5-year average PE, right? 13 versus 19. Although the price to free cash flow is the one thing that's concerning me, right? If you look at PE and price to free cash flow, Caterpillar is actually pretty clearly below both of them, right? If you look at Deere, 57 versus a 5-year average of 36. So the one problem with Deere is, yeah, it's growing quicker and it's growing faster, but you're paying significantly more for it, especially right now, right? Deere is very expensive where it's at right now. Caterpillar actually looks like you could be picking it up right here because it's 18% below its 5-year average price to free cash flow. It's 8% below its 5-year average PE. So based on those metrics, it looks like Caterpillar is the better buy right now, right? So let's get into the financials here because that's very important to look at as well. So again, this is going to be Caterpillar's. If we go to the bottom here, so free cash flow, Caterpillar's growing very nicely here. They are at an all-time high right now, which is very nice. Actually, they're not at an all-time high. 2013 was the highest, but they've been growing every single year. I guess they came down in 2020, but very nice growth since 2016, right? Very nice growth since 2016. If you look at, they are paying down debt. At least 2 of the last 3 years, they've paid down debt, which is something that Deere has not done, which I will show you. They also bought back a record amount of shares. They are consistently paying more dividends every single year, which is very nice. That's exactly what I want to see there. Let's get into Deere's just to compare it there. All right, so here we have Deere's cash flow statement here. All right, so like I see, you can see that they're consistently taking on debt, which is something that's a little concerning to me. Their debt situation definitely was worse than Caterpillar's. They did buy back a record amount of shares, which is really nice to see. They are consistently paying more dividends, which is also nice to see. Free cash flow is oddly low, right? It's oddly low. It looks like theirs is kind of all over the place. So that's something that you would have to dig into further, right? Again, if we get into the dividends here, this is actually I've already went over the dividends. Again, Caterpillar has a higher dividend right now, but Deere is growing it faster, right? So pick your poison on that one. If you're looking for growth, Deere probably is the way to go. But again, the problem with Deere is that it is clearly expensive right now. And let's get into that just for comparisons here. All right, so here we have the price to free cash flow, price to operating cash flow, and the risk premium. So again, if you look at the risk premium, Caterpillar is significantly better there, which is something that I like to see. Basically, what I would leave it at here is Caterpillar, in my opinion, is the better company to buy right now. although it looks like Deere has outperformed, and meaning it's probably a little bit better of a company. But again, you need to keep in mind that Deere is very expensive right now, especially based on a price to operating cash flow, and especially price to free cash flow, right? So I would be looking to pick up Deere in a pullback. Caterpillar, I think you can buy. You could probably pick it up right now because it is below the average 5-year average price of free cash flow and the 5-year average price to operating cash flow, right? So that's what I want to see there, right? So again, these are stocks that I think these stocks are going to continue to do well, right? I mean, does anyone really think that we're not going to need more and more infrastructure over the next decade or two, right? So I think that that's something that people really need to keep in mind, that of course we're going to need more infrastructure, right? Now again, Deere is more farming related. Caterpillar's more like government kind of buildings and roads and stuff like that. But you know what I mean, right? So that's why I'm interested in these companies. To be honest, I don't have a position in either of these. I will be looking into Caterpillar, and I probably will take a small position. But Deere, I would be looking to come up with a price range to say, hey, I'm willing to get into it at this point. Right, and I mean, let's just see Deere on the year just to see exactly where it's been. So it's definitely near its 52-week high of 448. It looks like it's actually very close to that, right? It hit that number in late last year. It also touched close to that in the spring of last year. In last summer, it came down to about 300, which looks like it was a great spot to pick it up. Ever since then, it's been in a clear uptrend. It's made higher highs and higher lows consistently. It looks like it might be in the process of making another higher high. We will see. It looks like it came down to about 350 in late May, so about a month ago, just over a month ago. Honestly, I'm not sure if that quite would even be cheap enough for me to want to pick it up, although I think I might start nibbling there. But it definitely would have to come down at least $50 or $60 before I'd be looking into it. And also the good thing about that too is you'd be getting a nicer dividend, right? So this is a company that I would definitely be throwing on a watch list. If it corrects nicely, then I would look into taking a position. If we look at Caterpillar here, over the last year, it is actually near its 52-week high as well. Although it looks like it corrected to about 209, 2010 roughly. That was just over a month ago as well. Again, this is a company that I would like to get it a little bit cheaper because it is near that 52-week high. But I think that based on a valuation basis, that you could be picking this company up right now, right? So again, obviously all my opinion, do your own due diligence and whatnot. If you like the video, hit that like and subscribe, comment. Any feedback is very much appreciated. So again, hit that like and subscribe and stay tuned for more.